Have you ever wondered if your financial advisor has your best interest at heart? I spent 16 years as a financial advisor on Wall Street, and I've seen the good, the bad, and the ugly. So what I thought I would do today is expose all of these myths, expose what your advisor might be trying to peddle you, and also tell you nothing but the truth. So having a financial advisor is all about getting guidance on your investing, budgeting, and achieving your financial dreams. However, I've seen so many folks relinquish way too much control over their money and their finances, and only to miss out on potential gains while their advisor reaps the benefits. Don't ask me how I know. So that's why it's important for you to identify what the lies are. Before we get into these truths and lies, what I'd like to do is ask you for something. I'd like you right now to click that subscribe button right at the bottom. And while you're at it, there's a little bell up top. I'd like you to smash that bell. You know, it's like a little jab, 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 right hook. Oh, yeah, that. And that will notify you of all the videos that I put out. So the first thing I want to talk about is the reality behind the profession I used to be in. You see, financial advisors, they're more than just advice givers. You see, their job is to make money, but not always just make money for you. It's to make money for themselves. And this always results in a little bit of a sales over service kind of scenario. So let's dive into some of these primary goals that many of the advisors, not all, but many of these advisors have. Selling products that benefit them more than their clients. When I was an advisor, I know we always had consultants come in. A couple times a week, we'd have to go in this little conference room and the consultants would come in and pitch the newest products or a new sales technique that we would use. But it was always a sales technique that resulted in the sale of the product that the broker was pushing. I know, it actually happens this way. And we would then go out and we would talk to our clients about that product. Now, here's what they won't tell you. Now, you already know your advisor's job is partly to sell products, but what you don't know is a lot of times these consultants that would come in, these wholesalers that would come in, and they'd have this product or this new fund or this whatever it was, they would incentivize us. Like if we sold this product, there was a bonus that we got on it. And if we hit a certain level of this particular product, we got this bonus or this trip. That's how it worked. And you know, we never talked about that to clients back then because, oh my gosh, don't want the clients to know. But you see, I'm not a financial advisor anymore. I don't hold myself out as somebody you come to for financial advice. I just tell you the truth. And the truth is, you're being duped. You're being sold products. That's what most financial advisors and brokers are out there to do. Whatever product their consultant's telling them to sell, they're out there selling it to you, making a commission, maybe getting a trip or a bonus, and maybe you don't even care about that. But I beg you to really ask yourself this question. What your advisor's telling you, is that really benefiting you? Is that solving the problem you have, or is it solving their problem? So lie number one, we were taught as advisors that dollar cost averaging was always the best investment strategy for the long haul. Now, I'm not saying dollar cost averaging isn't a really good investment strategy. Actually, let me pivot. Let me explain to you what dollar cost averaging is. Dollar cost averaging is the process of just investing over a period of time systematically. So for example, set up $100 a month, and every single month, that $100 a month goes into a specific investment. The thought is the markets go up, down, up, down, up, down, but over the long haul, what you're gonna do is average the cost down. Now, does this work? Absolutely. That's the good thing. So if you do this, if you dollar cost average in your 401k, in your brokerage account, in your investment account, yes, over a long period of time, you will bring the average cost down. But there's also some other factors that they don't tell you about. Dollar cost averaging, although it does work, a lot of times it goes against people if they're not doing it properly. And here's where people go wrong. They dollar cost average into a small basket of mutual funds, which is prevalent in most 401ks. They only have a couple mutual funds in some of the new 401ks I'm seeing. They've got target date or retirement date funds, maybe a bond or two, maybe a large cap, small cap, mid cap. So you pick which ones you want to go in, which usually what they're going to tell you is to put the money in the target date, the fund of funds. We'll cover that in a little bit. But when you do this, are you actually dollar cost averaging down? The answer is not always. Sometimes it works against you. So when you're looking at dollar cost averaging, you got to be very careful on how and to what you apply it to. I always tell people, if you're going to use dollar cost averaging, do it with new dollars going into the 401k. And that's going to work out quite well, especially right now. We're at the top of the market, okay? So as Warren Buffett says, buy low, sell high. You're at the top. So a strategy right now would be a bridge strategy. So take existing assets that you have in various funds within your investments and take the high ground. In other words, sell. Take the gains off the table. And the new money that's going into the 401k, which in most cases, what we always talk about here is just up to the match. That new money, dollar cost average into whatever fits your risk tolerance. That strategy very well might work. But what dollar cost averaging doesn't factor in at all is it doesn't factor in liquidity needs. A lot of times people have something happen in their life, and that something results in them having to take money out. So if they're dollar cost averaging in and they're then taking the money out, this might actually be working against you because you might have just been buying high. Over the last 10 to 12 years, we've been in the longest bull run history. So you've been buying up, 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 up. Not so much dollar cost averaging down. The one way to know what cycle we're in is watch a video that Mr. Ray Dalio put out. Just go on YouTube and look it up. It's called How the Economic Machine Works. And you can see very clearly where we're at in the economic cycle. But with that being said, let's move on. Lie number 2. Oh boy, this is a deep rabbit hole. This is fees, but specifically management fees or margin fees. And they come in many shapes and sizes. 12B1 fees, management fees, service fees. There's all sorts of fees on investment accounts, especially 401ks. I love it when people that have a 401k, they say, oh, we don't pay any fees for the 401k. Of course you do, silly rabbit. They just didn't tell you about it. Matter of fact, they did tell you about it. They said, here's the prospectus. And you know, back in the day, we would have to bring these big old prospectus in and give it to the client before we did an investment. Today, they just go online and everything's there. How many of you actually read the prospectus? I'm waiting. Actually, while we're waiting, click that subscribe button below and there's a little bell up top. Yeah, smash that bell. Okay, yeah, you found your prospectus. I'll probably have to give you about 10 hours to read it. Oh, you don't have 10 hours? Great. Well, that's what most people do. They don't read the prospectus, and that's where all the juicy stuff is. But you know who's reading this? The SEC. The SEC is reading those prospectuses. And if you go on to Google and you type in the effect of investment management fees on my portfolio, one of the things that will come up is an article that the SEC wrote, which is the Securities and Exchange Commission. It's a government agency. They will tell you the effect, and it's huge. So the management fees that you don't think you're paying, that you are paying, that you weren't told you're paying, that you don't even know if you're paying, yeah, those ones, 12B1 fees, management fees, all these other ones, they are eroding your investments' returns. The margin accounts, a lot of you have your own brokerage account, and you have a margin account attached to that. You don't know what the fee is they're charging you for that. That's an interest rate they charge on the money you're using for margin. Yes, that's going to the brokerage. No, it's not helping your returns. Yes, it allowed you to buy more stock, but again, is that helping you right now? So when you really are talking to your advisor should always talk about fees first. They should talk about what their management fee is. How much are they going to charge to manage your portfolio? Now, the average is anywhere between 75 basis points, 0.75%, up to, I've seen up to 2%, 2% being high. Anything north of 2% is really high. Oh, and by the way, variable annuities, you ever hear of those? Those are usually north of 3%. So you can just do the math, plus they got surrender fees. Oh, we're not gonna have time to get into those. There's just fees, fees, fees. But are you being told about all these fees from your advisor? So also, in your managed account that your advisor set up and is charging you only 1%, are there any other fees? Of course there are. The mutual funds that your advisor puts you in, those mutual funds carry management fees and 12B1 fees. Not only that, inside of your brokerage account, if you buy an ETF, yes, there's management fees. Although lower than a mutual fund, they're still there. So then it becomes a game of how many fees am I paying? Well, that's the unraveling that you got to get through. Probably quite a few. And those fees benefit the advisor in most cases. Almost all of them make their way back to the advisor's pocket in one way or the other. The brokerage gets a little piece, everybody gets a little piece except for you. The only thing you get to do is pay them. Yes, whether you make money or lose money, the advisor is making money. So that leads me to another thing that we're going to cover in a little bit. Why does your advisor always tell you you're in this for the long haul? It's just a paper loss. Oh, you got to ride this out. Because they make money even when you're losing money because of the fees. And also, the fees aren't just the management fee. Remember, mutual funds carry fees, the annuities carry fees, the ETFs carry fees, fees, all around fees. Let's move on to the next lie. So lie number 3 kind of comes right along with lie number 2 when it came to fees. And what I like to call this is funds of funds. Most of you don't really know what these are, but let me just give you a couple of the names that you're probably familiar with in your 401k or your retirement account. Sometimes they say retirement target date fund or retirement date. You know, there's always a date to it, 2025, 2035, 2045. They target your future retirement date. So what these are kind of the new funds that they've created for 401ks. Why? Well, because what they found is people that have 401ks don't know a darn thing about what they're investing in. So they wanted to make it simple. And if they can put the simple stamp on it, most people will invest money. And what they then found is, well, because these funds move with the client's targeted date and they readjust, we can charge more in fees. So again, back to lie number 2. So if your advisor is telling you, or your 401k advisor is telling you put your money in these target date funds, I'm not saying whether that's good or bad, but just know they're usually the most expensive funds out there because they are a fund of funds. Inside one of those target date funds, you got multiple funds inside of it, all with their own set of fees. And then if you're being charged a management fee on top, that's like a wrapper. Like think of a Snickers bar, right? What you want is the candy. You want the candy bar because that's what tastes good. That's your investments. That's what you want. You want the returns on the investments. That's the piece of candy. But to have a candy bar, have any of you ever gone to a convenience store and bought a candy bar without a wrapper? No, they all had wrappers on them, right? You think those wrappers cost some money? They're usually really pretty, right? They got all this graphics on it, and they usually come in like sometimes foil, and the fancier it looks, the more expensive. Well, that's just like these fund of funds. The wrapper, okay, on the candy looks really pretty, and they make it sound really good. But at the end of the day, it's really more expensive. And this is what you need to know. They don't say that it's double charging you, but I'm gonna tell you it's kind of like being double charged. Any of you ever gone to the store and you buy something and they accidentally scan it twice? You get pretty ticked off. You go out to your car, you're looking at your receipt, oh, they charged me twice. You rush back into the store, look at this, you charged me twice. But you ever do that to your financial advisor and be like, you charged me twice? You don't, do you? You just play good client.
Yeah, I don't know what I'm talking about. I got an advisor. Oh, he takes care of it all. Oh, yeah, he's got my best interest in mind.
Really? Because I hope by now, this is the third lie, you're starting to see that that is not always the case. Now, I'm not saying all advisors are bad. I'm just saying you need to be smarter. It's not about the advisors being good, bad, indifferent, selfish, greedy. It's about you being more educated on what this stuff is so you can ask the right questions and you can make the proper assumption of whether or not you got yourself a good advisor or a bad one, which brings me to the next lie. Lie number 4. So there's different kinds of advisors. Matter of fact, in today's world, some advisors aren't even advisors. Like for example, if you're buying an indexed universal life or an indexed annuity or anything with the word index, you think that's an index fund. You think you're buying into the index, okay, right? The S&P 500, the NASDAQ, the Dow Jones, some index out there. There are advisors, or saying they're advisors, selling these products that aren't even licensed. So they can't call themselves advisors. Matter of fact, in order to call yourself a financial advisor, you need to have a Series 65, 66, or a Series 7. And sometimes a combination of the two is better. So ask your financial advisor, are they Series 7 licensed? Do they have Series 66 or 65? Okay? 65 is the one that would make them a fiduciary. Okay? Series 7 makes them a stockbroker and gives them the ability to advise you on not just mutual funds and annuities, but also stocks and ETFs. See, there's a big difference. The people slinging IULs and index products, most of them are not even security licensed. I still can't understand how they can do this, because you know darn well they're selling an investment even though you're not buying an investment, you're buying a participation into an investment through an insurance company. Anyway, let me bring you back to what we're talking about. The fourth lie is fiduciary advisors versus brokers. So what's the difference? A fiduciary, like an attorney, has to act in you, the client's best interest. Every suggestion, every recommendation must be based on your needs and goals and what you want. And it better darn well be a proper recommendation based on your needs and goals. Otherwise, that fiduciary could be in deep trouble. You could take them and take them to arbitration. You could sue them. You could do all sorts of things if they don't act in your best interest. So if you're going to get an advisor, I would always suggest find one that is a fiduciary. It's not hard to find out. Just ask them. Are you a fiduciary? Do you have your Series 65? Do you have your Series 7 so that you can suggest and recommend individual equities and ETFs? Because if they're only Series 6 and 63, they can only call themselves a financial services professional. Big difference from a fiduciary advisor. Usually fiduciary advisors, in the bottom small stuff on their print and their card, it will say that they are part of a registered investment advisor, RIA, okay? So this is a difficult one because it requires you to be educated to know the difference between a fiduciary and just a regular broker or a financial services professional or just an agent pretending to be an advisor. So get educated on this. There are huge legal obligations behind a fiduciary. So a fiduciary must, like I said, act in your best interest. Versus a broker, well, whose best interest are they acting in? Is it the brokerage they work for? Is it themselves? Is it you? I don't know. But I think you need to understand this and ask the right questions. So how do you actually choose the right advisor? You know, I always like to say trust, but verify. The importance of doing your own research is very important. Questions that you need to ask are also very important. You should actually set up a checklist of what you should be asking them. And you should be looking for the red flags as they answer the questions. And some of those red flags really are what you need to look for is, are they making suggestions and recommendations based on your best interest and what your needs and goals are? Are they being transparent about fees? And are they emphasizing the importance of clear communication and understanding all of the stuff that they're suggesting, not just selling you a product for their benefit? I think one of the most important things that you need to do is just get educated. Get educated not on all the stuff that the advisor would do, but get educated on what it is you want. What are your needs? What are your goals? And if you tell somebody like an advisor that, oh, my goal is I want to retire. No, 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 no. When do you want to retire? With how much money do you want to retire? Do you want to pay less in taxes? What is your legacy plan? What do you need to do to get that set up? How do you protect your assets? See, there's far more than just saying, I want to retire. Of course you want to retire, so does everybody else, but there's a lot more that goes into that. Some of the other red flags, if they recommend or suggest to you a variable annuity, big red flags should go up. It should be like signs everywhere, beeping and flashing. And it's like your car, when everything goes wrong and your brakes go out, everything on your dashboard turns red. That's what you should be thinking. Whose best interest are they recommending based on? Another thing you would want to look for is, especially in 401ks, if they're telling you what to invest in within your 401k, do they know all the specifics? Or did you just say, I want to retire somewhere around 2045, and then they just put you in the target date 2045? They make more money doing that, remember. Or are they actually trying to understand your needs, your risk versus reward tolerance? That's the one I think that's missed the most. That's the one I see the most today. When I'm reviewing portfolios, one of the number one thing I see that is missed, that opens up that advisor for arbitration, lawsuits, and all sorts of stuff, is attention to what the risk tolerance is. I see people that are retired being invested like a 20-year-old. Why? Because they didn't get the advisor asking them the right questions. You know, they just say, oh, I'll put you in this managed portfolio. They're called SMOs and they got all sorts of names, but this managed portfolio where they're gonna make a management fee, but they're just gonna put you in this pre-baked thing, okay? You have no idea what's in there. So how can that be the right thing for you? Let me just give you a story. Recently, I was working with a woman. She got several $1 million. And she's got an advisor, and that advisor she trusted up until I reviewed her portfolio. The first thing I asked her is I said, you know, what are your needs, your goals, and how much risk are you willing to take? The first thing she said, oh, I can't take on any risk. I can't afford to lose what I've already made. I'm already retired. I don't want to work anymore. And if I lose money, I won't be able to maintain this standard of living. Now, I mean, all of you listening, that's pretty self-explanatory, right? When I looked at the portfolio, clearly the advisor must have been like listening to something, else Must have been on Instagram or social media when they were like listening to the client, because they missed that. Because she wasn't invested at all in low risk stuff. She was literally investing like she was 30 years old in relatively high risk investments that had no correlation back to her needs and goals. Her needs and goals were so simple: preservation of principal with income. That was it. So all she needed was preservation of principal, like I can't lose any money, so the portfolio should reflect that, and income, so in her portfolio should be some things that produce income. She had none of these. Maybe, actually, that's not true. She had a couple CDs, which would fit there, but I hate CDs. Anyway, back to what I'm saying is your advisor making suggestions and recommendations based on their needs or your needs? That's the most important thing you need to be asking. So let's just take a second and do a quick review and a summary of the lies that I talked about. There was 4 of them, and also their implications to you. The first thing we talked about was lie number 1, dollar cost averaging. Although I love dollar cost averaging, I think there's a right place and a wrong place for that to be used. Then we went on to lie number 2, and I went deep into this one. Fees, fees, and more fees. Do you understand the fees you're paying on the investments being recommended? And those investments being recommended, are they there for your benefit or so the advisor can make more money? Remember the red flags. The third lie that we talked about was funds of funds, target date funds, retirement date funds, a fund of funds that has the highest management fees. I'm not saying they're bad, but again, why are you being told that that's the place you should go? Is it because the person makes more money, or because it actually fits your needs, your goals, and your risk tolerance? That's a question only you can answer. And then the fourth one, the difference between a fiduciary advisor and a broker. And remember, I talked about the licenses. A fiduciary, a true financial advisor by definition, would need to have either a Series 65, a Series 66 license, or a Series 7. And usually it's going to be a Series 7 and a 65. That's usually what it's going to be. It's a combo. That would then qualify them as a stockbroker that is acting in a fiduciary capacity. You can look these up. You can go to the sec.gov website and look all of these up. And you can also look up the fees. Just check it out right here. I'll show you. This is the screen that you'll see, and this is the article I'm talking about the fees on the funds and the impact to your investment returns. So what I encourage all of you viewers to do is to be proactive in your financial journey, to seek transparency and to consider a second opinion. And that second opinion should be you need to take back control of your money. So this is just my personal reflection, and I'm emphasizing the things I learned by being an advisor, and I hope that you find yourself in a good place and not being sold a bag of lies by a financial advisor that's making suggestions for their own pocketbook. So if you find yourself being sold one of these lies, or if you've ever been screwed by a financial advisor, then write down in the comments, put that. Tell us what you've experienced. And if you could, take the time to find the way to take back control of your money by watching more of these videos just like this one. Matter of fact, this is a great time for me to suggest this video right here, because this video talks all about alternative investments and how you can be your own bank. Thanks for your time today. We'll see you on the next one.